Thank you. And let's just go directly into it, starting with the highlights of the year. Financial year 24 has been a special year in Benchmark, a year of considerable change in the business, a year and concluded a strategic review, and a year where we have experienced market headwinds for a significant part of the business in the group. Despite this, we have managed to stay resilient to deliver an outcome that has brought Benchmark forward to a better position for the future. Given that we now have concluded the strategic review, let me start by commenting on this. As you are aware, the outcome of the comprehensive review that we've been through is that we have signed an irrevocable agreement to sell our genetics business to Novo Holdings. We firmly believe this is a good outcome of the review. First of all, we believe the deal very well reflects the significant intrinsic value of the genetics business that we have been developing over the years. Then, the significant proceeds from this transaction also will enable the company to pay down expensive debt, both the NOK bond that we have and the RCF, and return significant capital back to the shareholders. Finally, the deal will enable the company, on the basis of solid financial and operational footing, to focus on realizing the real values in the remaining two business areas, advanced nutrition and health. The process that we have gone through to get to the conclusion was comprehensive, and we received offers for all the three business areas as well as for the group. For the reasons I just mentioned, we are confident that the outcome of the review is good for the company and the shareholders. The transaction is expected to close in Q1 calendar year 25. Post-closing of the transaction, Benchmark becomes a less complex company with a significant opportunity to further streamline the organization to reduce costs, thus be in a good position for value creation for our shareholders going forward. Before leaving this reflection on the deal, just a few reflections on the genetics business that are now being sold to Novo Holdings. This is a business that, during the period of ownership of Benchmark, has developed to become a considerable force, high-quality business, a leading player in the aquaculture genetics space. From the beginning, this was also very much the intention. But if we go back to the starting point, back in 2015, the starting point was small fractioned businesses within the area that was gathered, and over the years has been invested in and developed to become a really significant, high-quality, coherent business. This is also reflected in the significant value achieved through the transaction, and this evidence a value creation Benchmark has been able to generate over the years, an ability that is being applied and will be applied also for the remaining parts of Benchmark. Then let's move over to talk about the operational performance in financial year 24, and I will refer to the group figures in totality. Septima will touch more into the continuing business in her part of the presentation. As I started out, financial year 24 has been a year of considerable change, a year with market headwinds for a significant part of our business. Despite this, we have managed to stay resilient to deliver a result that reflects dynamic mitigation of the challenges that we have been facing throughout the year. The top line for the group ended at 147.7 million. This is a reduction of 7% in constant exchange rate compared to last financial year. Behind this top line, we see a growth in top line for advanced nutrition in constant of 5%. We consider this as a strong performance of this business area, given the significant market headwinds for this business area that they have been facing in the shrimp market, which is their main market. It's been a challenging year market-wise for this business area. So we consider the growth on top line as being a strong performance. Revenues for health were down 41% compared to last year. This is explained by the considerable change and restructuring we did in this business area during the year, taking out the 2 PSV-based platforms for CleanTreat as a first and needed step towards a less capital-intensive business model for Ectosan. Doing so implied far less top line for this business, but on the contrary, we now have positioned the business area to be profitable and cash positive going forward. Finally, genetics, where we saw a reduction in revenues of 8% in constant exchange rate during the year, still reflective of a good year, but a year where we did not benefit from the extraordinary uplift caused by supply constraints that we experienced back in financial year 23, but also in 22. Also reflective of a shift from direct sales to indirect sales in the joint venture that we have with SalMar. Moving over to below the top line to our adjusted EBITDA excluding fair value, the group as a whole ended with an adjusted EBITDA excluding fair value at 28.9 million, which is down 10% in constant exchange rate compared to last year. This is explained by a reduction in the top line, as well as a reduction in gross margin due to changes in product mix for nutrition. I will come back to that a little bit later in my presentation. Partly, the outturn has been mitigated by a significant reduction in operating costs in the group, which has been taken down by 15% during the year. Unlike last year, this year ended with an operating loss for the group. We are, of course, not happy with that. Partly, it is explained by the lower revenues and the gross margin that I just commented, but it should also be noted that the figure is significantly impacted by impairment of a total of 15.3 million, out of which the majority comes from an impairment of capitalized development cost related to Ectosan Vet and CleanTreat, reflecting a prudent approach, given that we have paused the commercial activities for that solution, while working on tangible alternatives to relaunch the solution on less capital-intensive platforms. Then to move on to a few words on how the last quarter, Q4 of the year, was developing for the group in total. Top line in the quarter ended at 36.8 million, an increase of 7% in constant exchange rate compared to Q4 last year. Behind this group figure for the quarter, we see growth in top line for advanced nutrition business, and I've just commented on that. We think that's a strong performance given the market conditions. While we have seen a significant reduction in revenues for health, again, for the same reasons as I've just previously mentioned. In genetics, we had a solid quarter with modest growth compared to last year. Our adjusted EBITDA, excluding fair value for the quarter, ended at 6.9 million. That's a reduction from last year. As I will come back in a minute, this reflects a lower gross margin due to product mix in advanced nutrition, but it also is influenced by unfavorable movements in biological assets in genetics in the quarter. On the positive side, the figures on the adjusted EBITDA also reflect our effort to mitigate to a reduction in operating costs, which has gone down 35% compared to Q4 1 year ago. Also for Q4, the operating we see an operating loss. Again, as already commented, it's driven by the impairment, a consequence of prudent approach to the capitalized development cost in health for the reasons that I just mentioned. Moving over to give a little bit more granularity on the operational performance in the year, in the two business areas that will remain in the group after the transaction, namely Advanced Nutrition and Health. And starting out with Advanced Nutrition, that has shown great resilience, demonstrating commercial focus in difficult market conditions. We are happy that that has actually led to an increase in top line measured in constant exchange rate in the year. The challenge for the business in Advanced Nutrition, or INVE, which is the well-known brand name for this business area, besides being difficult market conditions in shrimp, has been the product mix. The challenging market situation in the shrimp industry has made it more difficult to sell the highest margin products in the portfolio due to increased price sensitivity of the customers. In addition to this, Artemia is a natural resource with fluctuation in hatching rate. Hatching rate is the key quality parameter for Artemia, and during the year we've had a greater influx of inventory of Artemia with lower hatching rates, thus lower margin. So the combination of less sale of the high margin products due to the market conditions and an influx of the hatching rate, of lower hatching rate, lower quality Artemia, has impacted the gross margin in this business area. This is a situation we expect we will move out of over the coming period, as we are now moving into inventories of Artemia, at least, with higher quality from the last harvest seasons in Artemia. As I've stated in previous presentations over the last 2 years, we have had a strong focus in optimizing our performance in Advanced Nutrition, regardless of the market situation that we've been in. Decisive actions have been taken to strengthen our commercial focus, broaden the product range, and increase operational efficiency to mitigate market cyclicality. Even though we are down in performance against last year, we are very confident that the performance we are showing in this business area reflects these actions, and it demonstrates a strong ability to mitigate the situation that we have been in. A few words about the market situation for Advanced Nutrition. The good news is that the market in marine fish, which is also a segment that we are in throughout the world, the main part of the marine fish market is the sea bass, sea bream activities that we have in the Mediterranean. That has stayed quite stable, and we have been able to perform well. The challenge has been and continues to be the global shrimp market. That is still difficult with low farm gate prices to the farmers, which again affects their ability and willingness to stock and grow the production in the various regions. That trickles down to us. We feel confident that this will turn over time, but when it will happen, it's still uncertain. What we will continue to do is to focus on what we can do something with. We cannot do something with the market situation, but we know that we have a very solid and tuned organization and management at Advanced Nutrition INVE that has been strengthened over the last year. We know that we have a very good and wide product portfolio that is in continuous development, and we know that we have a very relevant footprint in the market that has also been widened and strengthened over the last year. With this in mind, we are confident that we are in a good position in the current state of the market, but also for when the market conditions again are turning to become more positive. Moving over to talk about the second business area that will be remaining in the group, Health. This is a business area that has gone through a very significant change over the last year, which is reflected in the financials. The restructure we have done as a first and needed step to transition from a very capital-intensive business model for Ectosan Vet CleanTreat has impacted our top line and adjusted EBITDA in the year that we have finished. I've already commented on that. At the same time, it has positioned this business area as a smaller but profitable and cash positive business with the capabilities to grow going forward. The current commercial backbone of the business is our original sea lice medicine, Salmosan Purisan, that is still doing well in the market as one of the very few medicines available for efficacious sea lice treatment for the salmon industry. But we have also kept our capability to provide the Ectosan wet and clean treat solution. And given the magnitude of the sea lice challenge in the Norwegian and Chilean industry, there is still a significant potential for this solution. Interest is in the market, and we continue to work on setups, as well as being in dialogue with customers and partners to get this solution live again. This time on the platform, which will be less costly, less capital intensive, both for Benchmark as well as for the customers. It being on the barge, integrated into wellboat or land-based, the latter being a solution that will significantly bring down the cost. So with these words on health, I end this introductory part of the presentation and leave it up to you, Septima, to take us through the financials. So over to you.
Thank you, Trond. So, as Trond noted, given where we are in terms of the divestment process for the genetics business, I'm going to focus on the continuing business. So what is the continuing business when we look at financial year 24? That's the total group business that we operated during the year, less the business being sold. It's important to note that the perimeter of the disposal is the standalone genetics business, without any allocation of the group corporate costs, which would have been £1.9 million in financial year 24. That cost is now incorporated in the continuing business for financial year 24, as it effectively existed within the business for financial year 24. And therefore 16.7 million of EBITDA has related to the genetics business has been excluded as discontinued. So what does the business going forward look like? We will still have the business areas of nutrition and health, but when we look at the corporate costs for financial year 24, we need to remember that this was reflective of a corporate function designed to support 3 business areas. So naturally, this will change, and as Trond has noted, we expect to be able to take down some of those costs. So moving on to look at the numbers. When we look at revenue in the continuing business, and particularly for our nutrition business, Trond used the word resilient. End markets, particularly in shrimp, have been challenging through the year, but the focus of the commercial team has been to create sales opportunities where possible, and this was clear where, given the fact that we grew at a constant exchange rate within the nutrition business at 5%. For health, sales fell by 41% at a constant exchange rate, but this was driven due to the exit of Ectosan from the market. And within health, when you break it down by product area, sales of Salmosan or Purisan fell slightly to £7.8 million in the year. But this product continues to deliver from a sales and a profitability point of view and will be important as we move to the future. From a gross profit perspective, as Trond noted, sales of Artemia were of a lower hatching rate, ultimately with lower margins. And this mix effect resulted in a drop of gross profit of 11% at constant exchange rate for nutrition. But at an absolute level, the nutrition business continued to deliver gross profit of £36.7 million within the year, a very important part of the future of the business for the future. Health also saw the reduction in gross profit by 41% due to the exit of Ectosan from the market. Whilst the reduction in gross profit is significant, the change in business model was driven by the need to remove the cash burn aspect of the old business model from the business and focus on profitability and cash generative parts of the health business. And this objective has been achieved through the restructuring of the health business area. Salmosan has delivered gross profit of £5.8 million within financial year 24 and will act as the base for the profitable and cash positive health business for the future. From an operating cost and an R&D cost, I'm going to look at those later in the slides. But I think the approach in the business has been to try and mitigate, where possible, the lost margin. And whilst we haven't been able to fully achieve this, we were able to partially mitigate this, resulting in adjusted EBITDA of £11.9 million from the continued business. When we look at the adjusted operating loss, this includes the 15.3 million of impairment of development costs related to mainly related to the health business. Now, this impairment occurred because we could not, with certainty, predict the timing of the Ectosan cash flows coming back to the market. Exceptionals of 5.6 million are mainly related to the program, the strategic program, which we've had underway during this year of £4.5 million, with the balance related to restructuring within the continued business. And of course, I'm going to bring you through the net financial expenses on one of the next slides. But overall, when we look at the loss before and after tax, which has significantly grown, this has been a result of challenging trading, but also high impairment, which is one-off, high exceptionals related to the transaction, which is one-off, and high finance costs, which will be positively impacted through the successful culmination of the divestment. So when we come to look at the income statement for the future, the shape of the income statement will, we expect, change dramatically as a consequence of the divestment transaction. If we could move on to the next slide, please, to look at operating costs and R&D. Looking at operating costs, as you can see within the continuing business, we have seen the challenges in the nutrition businesses and the restructuring of health, and have really remained focused on good cost control. Whilst some of this cost reduction is due to bonuses not being paid of 3.5 million, the balance of the 3 million reduction is due to good cost constraint as we move through the year. And these cost reductions came from all business areas in the continued business: nutrition, health, and corporate. In R&D, we continued to invest in R&D within our business, particularly within the nutrition business, as we remain committed to growing the portfolio and supporting the future growth of the nutrition business. We further reduced the spend in health as we ceased some development programs as part of the restructuring of the health business area as well. If we can move to the next slide. So, looking at net financial expenses, as I noted earlier, the shape of the finance costs will be positively impacted by the deal completing and that creating the ability to repay the debt. Looking at it down the main components, foreign exchange will continue to be a factor of the continued business, but the nutrition business mainly trades in US dollars, so it has an element of natural hedging around it. Health has some FX exposure to NOK and USD, but not as significant. When we look at the interest on the bond and bank debt, given we have stated our intent to repay the debt, this line item should be much diminished in the future. And similarly, if we have a much more moderate working capital facility, the deferred financing fees would also be much more moderate associated with that. As the debt will be repaid, so too will the hedges, which will remove the hedging referenced here, which is associated with the NOK bond. We will continue to have interest on leased assets within the continued business, but as you can see, it's much more moderate for the future as we move forward, where the main leased assets are one of our nutrition manufacturing facilities in the US. Moving to the next slide. As we've previously stated, the intention is to repay the NOK bond and the RCF debt with the part of the proceeds of the divestment. In terms of the Sultan debt, the deal's on a cash-free, debt-free basis, and therefore that will be getting repaid at the closing of the deal. This will leave the remaining group with a very stable balance sheet and the ability to return capital to shareholders. When we look at the cash flow that we can see here, this is for the total business as a whole, but I'm going to put particular focus on broadly what will fall away as we move into the future. From a working capital perspective, we have a fairly significant outflow in the period, driven throughout the business areas. We had the normal timing of trading items, such as increased receivables and inventory due to tough markets and timing of sales and costs within the nutrition, health and corporate business areas. But in health, we had a one-off 2.2 million reduction in provisions due to payments for the decommissioning of the PSVs in the year. This won't recur in the future. And also the increase in working capital investment in genetics of £4.8 million. In the post-divestment world, this will also fall away in the future. When we look at taxes, as I've previously noted in other presentations, we pay tax in our main tax-paying jurisdictions of Iceland, Norway and Belgium. As we divest genetics, some of this tax burden will of course fall away. In financial year 24, we paid £3.7 million in cash tax for genetics. Looking at the interest expense, as I noted for the income statement, the majority of this cash out relates to the interest on the debt at PLC, which is intended to be repaid as part of the proceeds from the sale, and also the interest on genetics debt and leases, which will either be repaid or transferred on divestment. But as we move forward, we expect that the interest charge and cash interest is primarily driven by interest on leases, which exist in the remaining business and will be much more moderate, as noted earlier. From a CapEx perspective, we did continue to invest in moderate CapEx in the business throughout the year. But the majority of this was genetics of £2.2 million, which will not reoccur post-divestment. The balance was split between health of 0.1 and nutrition of 1.6 million, supporting the production facilities in Thailand and the US for nutrition. And of course, as we sit here today, we currently still have the debt and associated interest until we have completed the transaction. But once the debt's been repaid, we feel that these steps will strengthen the remaining business, allow it to move forward and focus on utilising the cash generated in the business within the business. Overall, the divestment of genetics will strengthen the balance sheet and leave the business in a much more cash generative position as it moves forward into the future. I'm going to hand it back to you, Trond.
Thank you, Septima. Let's go on to talk about strategy and the outlook from where we stand today. As Septima has ended her part of the presentation, and initially we think that the outcome of the strategic review is good, not only because we believe that the sale of genetics fully represents the intrinsic value of what the genetics business has developed to become over the last years, but also because it will put the group on a good, with a solid balance sheet, with a leaner, less complex and streamlined organization, with lower cost and an ability to focus on realizing the value that we have in the two remaining business areas. And the potential in both business areas is definitely there. Both businesses are positioned to be cash positive, have leading positions in what they're doing, have an invested infrastructure, good organizations, and headroom to grow. And this creates an opportunity to realize values for shareholders. And the focus will be exactly that. Strategically, both business areas are well defined. Advanced Nutrition, or INVE, which is the brand name, is a highly specialized nutrition and health business focused on solutions for early life stages, so far targeting the global shrimp and marine fish markets. INVE represents a very well invested platform within this space, with an excellent solutions portfolio, a solid supply chain infrastructure, an impressive commercial organization covering all relevant markets, as well as a very solid and experienced management. As an organization and as a business, INVE has developed strongly over the last years, which is evidenced by the resilience shown in the 2 years when we have experienced considerable market headwinds. Where we are now, the business is well positioned for when the market again turns, as well as to expand its reach to an even wider sphere of the aquaculture industry. Staying true to what is the core of the strategy within Advanced Nutrition, staying as a highly specialized business, commanding high margins in what they are doing. Health is, as I've repeated several times during this presentation, now in a state where we have taken decisive grips, and it's now emerging as a lean, profitable, and cash-generative business with a solid financial platform from the business generated to the well-established business of Salmosan and Purisan. But as I also have repeated, Health has a significant bigger potential than that through Ectosan Vet and CleanTreat, where we have kept our capabilities and continue to work on alternative platforms that through a dialogue with customers will enable a relaunch of this solution. This will be platforms that are far less capital intensive than the solutions involving the PSVs we used in the introduction of the solution. I've previously spoken about models integrating into wellboats and barges, but it could also be land-based models. These will be platforms that are owned or operated by the customers, where Benchmark provides the knowledge and holds the financial potential of the medicine Ectosan Vet. For anyone who doubts the need for Ectosan Vet as a medicine and CleanTreat as a part of the tool for the sea lice treatment in the salmon industry, I will just point to the situation that has been in Norway during the fall, where the sea lice issue has been worse than ever. It's not solved. And the situation is not better in other regions, including Chile, where the lack of tools that actually works really has put the industry to new tests during the year. So finally, moving to some words about the more immediate outlooks over the coming quarters for the remaining business in Benchmark. For nutrition, the start of the year has been continuation of the challenging trading conditions seen in financial year 24. Still a difficult market. Post-period, we've also experienced a loss of a significant customer in Venezuela. As we all know, the political situation in this country is unstable, and the government in this country has taken control of the operation-specific customers. So despite the fact that the business in itself keeps on delivering resilient performance, we expect the impact of that we expect a soft Q1. During the year, however, we expect a recovery in the gross margin, which in last year was impacted by the product mix, partly due to the nature of the Artemia harvest. We are also confident that the actions taken over the past years to strengthen our commercial effort, broaden our product portfolio, and increase operational efficiency to mitigate the impact of market cyclicality, position us to deliver growth and improve profitability in this business in the periods to come. In Health, we have had a good start of the year. Our well-established solution, Salmosan Vet, Purisan, is well positioned, and we've seen good sales. With a reduction in the cost base, our Health business is expected to be profitable and cash positive going forward. That's the basis. At the same time, we continue to work with customers to develop viable models for Ectosan Vet and CleanTreat with the aim to relaunch this solution into the market. For the group as a whole, the focus will be on simplifying and streamlining the group structure, which is expected to result in significant cost savings. This effort will commence upon completion of the transaction, closing of the transaction, taking into consideration the company's commitment under the transition services agreement that we have entered into with Novo Holdings, which we aim to complete in the 3 months after the closing. We expect the streamlining exercise that we are now moving into to be completed by the end of Q3 in financial year 25, and therefore we'll see the benefits from the cost savings coming through in Q4 and into financial year 26. And with those words, I end our presentation, and Hannah, we are open for questions.
Did Novo not have an interest in acquiring the whole of the Benchmark business? There are clear synergies with both the animal nutrition and health sides of the business.
I don't think we should comment on any specifics of, what we have said very clearly is that, we have interest for all the three, and we have interest for the group as a whole. We think that the outcome that we have now gotten is the best one for the company. That's why the board has decided to recommend this outcome. So that's the answer to that question.
Thank you. Do you have a view on the timescale or criteria for putting any of these businesses back on the market, or will they now be managed with a long-term investment horizon?
The strategic review is ended. That's the end. And the outcome of the strategic review is that we are selling our genetics business to Novo Holding, a reputable buyer. And you have two remaining businesses in the group that we intend, and the focus will be to develop the values to the benefit of the shareholders going forward. So that's where we are, and that's the short and long of that story.
Thank you. I do have a question here, which I think I probably need to answer. What are analysts now forecasting for EBITDA for full year 25 and 26? And certainly from our perspective, I can say that we are currently updating models and will be publishing a note in the near future. I don't know if you have anything you want to add to that.
I think it's important for everybody to understand that as we're in the midst of the transaction, some of the analysts that we would normally work with had been restricted, and so therefore coverage had been either taken down or had been paused. We are now in the process of trying to reinitiate coverage on a more robust analyst level to ensure that we can correctly reflect the future of the business as we move forward in a post-genetics divestment world.
Thank you. What are your financial medium-term objectives for the health business in its new business model?
Septima, you could probably start on that.
Well, so from a practical point of view, in the short term, the financial metrics associated with the health business will be the sale of Salmosan. What I can say is within financial year 24, we sold £7.8 million worth of Salmosan, which then generated gross margin of £5.8 million of gross margin. So this is a good margin product. And then we will have, of course, some OPEX to support that going forward. So that's going to be the sort of financial metrics associated with the health business as we move forward. Then, of course, we have the potential upside around Ectosan Vet and Clean Treat. Where we struggle around that from a guidance point of view is the timing of reintroduction of it into the market. Because we want to do this in the right way to create shareholder value by having it reintroduced into the market through the new business model, the timing of that coming through is as yet uncertain. But we had always significantly robust margins associated with the medicine part of that value proposition, and that does not change in the new business model.
Thank you. How much net cash do you aim to retain within the business following the sale of genetics and the return of capital?
Definitely, we could probably take that one also.
So from when we look at the nutrition business and also the health business, they will both be cash generative in the future. And so what I expect is that we will maintain enough cash in the business to have a sufficiently robust balance sheet to allow those businesses to continue. We will do that probably supported by flexible working capital facilities to allow the ebb and flow of the day-to-day trading. But our objective would be to retain enough cash in the business for stability, but not too much cash in the business that ultimately could better benefit the shareholders.
I'm conscious that in your statement, you have obviously said that the amount of cash to be returned to shareholders is forthcoming, but is there any additional colour you can add to that?
Well, when you look at the cash that will be generated out of the transaction, we've spoken of the fact that we expect to get gross proceeds of 200 million and that we intend to repay the debt that's within the business. So, you know, a sufficiently significant amount of cash will still be remaining to allow us to distribute that back through one form or another back to the shareholders. One of the objectives around this strategic review was to create shareholder value, or to unlock shareholder value through the strategic review. And so that's been an important consideration for the board as we've moved through the decisions around this. We want to ensure that shareholders are appropriately rewarded for sticking with us.
Thank you. Probably another one for you, Septima. You mentioned the strategic review has cost 4.5 million. Does this include your transaction costs regarding the genetics disposal?
This is a portion of the costs associated with the disposal itself. There will still be more to come on top, because a lot of the work that was done and also the completion of it all will have happened in Q1 of financial year 25. So there will be some more exceptional costs to come, but then once it's done, it's done.
Okay. Trond, on the lower hatching rate, do you detect any underlying changes, for example, water temperatures, which may point to a longer term trend?
Actually, not a longer term trend at all, you know, but it's a temporary trend that we've been through. You know, I think it's quite well known that, you know, we are now talking about the Great Salt Lake, that the water levels in the Great Salt Lake for some years were going down to very low level, to low levels, and that has had an impact on the quality of the hatching rate, or the quality of the cumulative. In the 2 last years, you know, that has been returned. You know, the water levels are getting up again to more normal levels, or even, you know, have a trend upwards, which again causes better hatching rates. So it's not a long-term trend. No, it's a fluctuation. And this is a natural resource that will always be impacted by the surroundings, you know, the environmental surroundings. But there is not a long-term trend. It's more like a fluctuation over years. Yes.
Thanks.
That we have also seen historically.
And in health, can you tell us more about conversations with customers around the infrastructure configuration required for a land-based operation, for example?
A number of conversations going on with different players, from service providers to farmers. You know, the interest of the solution is definitely there. It's about finding the right configuration that allows, you know, a relaunch on the basis that, you know, the capital intensity of the solution should be less, the operational, you know, cost relation to the clean solution should be less, and to find that right configuration with the clients that we are talking to. It has been a little bit delay in the conversation because, you know, in this fall, the sea lice situation in Norway has been grim, and it's all news. You know, it's been all over the newspapers. You know, so they've been more focused on battling what they had than to think through, you know, what kind of solution do they need for, you know, in the coming periods. But there has been communication, and that we are intensifying again now when the main sea lice pressures, at least naturally, should be a little bit more easing as we are moving into the winter again.
Thanks. What will be the general level of capital spending and R&D investment going forward?
Septima?
So the capex will be mainly associated with the nutrition part of the business, supporting the manufacturing facility in Thailand and the US. And of course, it'll be lumpy. It'll range between 2 and 4 million on average, I think around 3 million, dependent on what different capital programs that they have in place. It's a well-invested facility, particularly the large facility that we have in Thailand. And the capex that we would have kind of the intention to spend will be to create more operational efficiency and further expand and control capacity within that facility. From an R&D perspective, we'll continue to invest within our nutrition business in R&D to further expand and control our portfolio and optimize what we're getting out into the sales line. I don't expect it to increase significantly. I think it's been, consistently around the 2 to 3 million pounds on an annual basis for that part of the business.
And given the reduction in corporate costs indicated, can you give us an idea of the scale and type of central operations required?
Well, from a practical point of view, that's a piece of work that's being looked at, in the coming months. There's no value in looking at a corporate cost reduction program if we had no certainty around the deal completing. But from a practical point of view, it's a smaller group. You'll have smaller activities. You'll have a smaller group to audit. So there's a scale aspect in terms of the management of the group from a lot of different aspects. And we will be investigating all of the different areas to ensure that we can optimize from a cost perspective.
Great. Well, that's it for the questions. So just leaves me to thank our audience for joining us and to you both for your time today. It's been an impactful 2024, and we look forward to more of the same next year.
Thank you
very much,
for attending. Thank you.